Good morning. My name is Arabella Hayward, and I'm an associate within the insurance team at Mills and Reeve. Today, I'll be discussing insurance cover for employee fidelity. Before starting, I would like to let you know that this session is being recorded, and whilst you can see me, I can't see you. We will have time for a Q&A session at the end, and if you have any questions, please post them in the Q&A box at the bottom of your screen. My colleague and senior legal advisor, Harriet Strevens, will pick them up for us at the end. If we do run out of time, we will deal with your questions separately after the session via email. So, what is employee fidelity? This involves the fraud or dishonesty performed by workers or other trusted individuals of a business, which is carried out in the course of their employment and which causes a loss of property, including money or goods, to their employer. This is often also referred to as first-party fraud. Breach of trust by employees is a growing risk faced by businesses. There can be many reasons for an employee to act dishonestly, including but not limited to financial hardship, dissatisfaction with career growth, and temptation. And we all hope that these issues include the minority of the workforce, but they also extend to employee theft and fraudulent acts, which can result in huge business losses. The good news is that there are a number of ways that businesses can protect themselves from these risks, and one of those is taking out fidelity insurance. There are specific standalone insurance policies that can be taken out to cover against this risk, or it can be added to existing policies. The cover itself can be referred to as fidelity bond insurance or fidelity guarantee insurance, but generally speaking, these all mean the same thing within the context of an insurable entity. And for the purposes of this presentation, we refer to it as fidelity insurance. This cover provides protection against business losses caused by employee dishonesty, theft or fraud, and compensates for those losses within the limitations of the terms of the policy itself, along with other common forms of corporate insurance. General theft clauses can also be used to cover employee fidelity. However, there are some perils to be aware of, which will be touched upon later. So why is employee fidelity a growing concern? Basically, this is because of the increase in the level of fraud claims, both in frequency and in value in recent years. And there are several reasons for this, but the main factor is that online banking makes it so much easier to fraudulently transfer money. In today's business world, where fraud and dishonesty are increasingly common, fidelity insurance acts as a key risk management tool for a business. To illustrate just how wide the ambit of fraud can be, the slide shown now includes 7 of the most common areas which are frequently hit. Obviously, in every occasion mentioned, fraud is perpetrated by the employee. And whilst I shan't recite the elements of each, let's look at 4. So false invoicing. This happens when, for example, an employee creates false invoices to be paid to companies that they control. We are involved in a matter where certain employees of an entertainment group in the US had, across sites and over several years, colluded to generate bogus invoices that purported to relate to cleaning and other maintenance services. Each invoice was below $2,000, which just went below the threshold when an expense would need to be reviewed by a more senior person. This allowed the misappropriations to go under the radar and accumulate into the millions. So fraudulent HMRC payments. This involves when an employee who is meant to be sending funds to the tax authorities misappropriates the funds instead. We've been involved in a matter where an employee of a law firm fraudulently sent funds to third parties instead of sending them to clients or other entitled parties. The payments were made in connection with a genuine property transaction run by the employee. The fraud was found out through chases received from the HMRC in respect to the outstanding SCLT on transactions that had purportedly already been concluded. So inventory fraud. This happens when an employee steals the company's inventory and uses it as if it's their own. Again, we're involved in a matter where an employee of a car dealership was manipulating records around customer orders and vehicle stocks to hide the fact that over several years they were sending themselves funds totaling hundreds of thousands to fuel a gambling addiction. And finally, public official fraud, which relates to officials stealing from a public body or charity through using money to pay for their own personal expenses. We've been involved in a matter where an employee of a local authority had been responsible for administering highway bonds and stole £1 million over 4 years before it was discovered that they had been issuing the bonds payments purporting to be legitimate contractors. In fact, they were sending the bonds to personal acquaintances. And underlying all of this was 1, a gambling addiction, and 2, a desire to set up a leading ghost hunt business in the UK and the US. In that case, we obtained disclosure orders and freezing injunctions and worked with the police, and the employee has since been extradited back from the US to the UK and convicted. So who needs this cover? Well, typically this type of policy would be taken out by companies or corporate entities who have employees handling cash and or dealing with payment processes. These are the insured's first in line. The risk of loss under a fidelity insurance policy is governed by the opportunity to be dishonest or negligent, as afforded by the type of employment. Such opportunities vary according to the nature of their particular occupation and the position within the business which they hold. It is as well to remind ourselves that the Association of Chartered Certified Accountant Regulations, ACCA for short, require that member firms in public practice with more than one member of staff must have at least £100,000 infidelity insurance cover in place for any one claim to help protect the business and enable it to continue trading following the event of a fraud. So how is this accessed? Obviously, the first response to this is to ask a broker. As fraud becomes increasingly prevalent, we see that some insurers are beginning to omit this cover from the PI policies that they offer as standard. This is particularly so when offering insurance to accounting firms. In the 2013 case of Ted Baker plc and another, and AXA Insurance UK plc, it explored whether it was market practice for theft by employees to be covered by a separate fidelity insurance policy or a general theft clause within a commercial combined insurance policy. In that case, the first defendant argued that it was market practice that theft by employees would be covered by a separate fidelity insurance policy. The experts relied on by the parties agreed that 1, fidelity insurance covers theft by employees, although the cover is usually wider than that. 2, violent and forcible theft was standard cover for extended combined policies. And 3, cover for non-violent and forcible theft was available upon request. The court, however, held that the effect of the clause was to provide full theft cover, and there was no exclusion of employee theft. It might be that this type of exclusion was normal market practice and often incorporated. However, that had not happened in the instant case. And on that basis, the court held, and I quote, that there is no reason in principle why a policy which covered theft should not include theft by an employee. The court did not consider that the evidence of market practice at the time could displace the ordinary meaning of the words used in the policy. And finally, the court did not consider that it was permissible to take into account that a theft by employee section was not selected to aid the construction of the theft section of the policy. Therefore, insurers should be alive to the wording of their fraud sections within existing policies if they intend to exclude employee fidelity under the policy. The ACCA practicing regulations state that fidelity guarantee insurance may but need not form a single policy with such PI policy, and all such PI insurance and fidelity guarantee insurance must remain in force for all of the period during which a relevant practicing certificate is held. Do we need to address the question of risk, and what do we mean by it? Yes, it is important to understand its definition in the context of its use. When first obtaining a fidelity insurance policy, the employer is usually required to provide a statement of the capacity in which the employee is employed and the nature of their duties. However, if this statement is incorporated in the policy as part of the definition of the risk, the employee must continue to be employed in accordance with the description throughout the currency of the policy. And what happens if that isn't the case? Well, if the capacity changes materially after the policy incepts, and materiality is the key word here, or the employee is required to perform different duties that are materially different to the statement that's incorporated, the policy will not respond to a claim since there is an alteration of the risk which affects its identity. So when considering the question of risk, it is crucial that any material changes are notified to insurers immediately. Insurers might take a careful look at the wording of their policies to make this notification an obligation to the continued cover being present. That said, any alteration in matters of routine, such as the precautions against dishonesty adopted by the employer and the method of checking the employee's accounts, does not affect the identity of the risk and does not in itself preclude the employer from recovering. So as I say, the insured must be mindful of the risk at all times. Looking at the wording of the risks, in general, technical terms of criminal law are used to describe the risk, and the policy refers specifically to losses by theft. Where this is the case, the words must be construed strictly as they bear the same meaning as an indictment. This means that the insured cannot recover unless they prove that the particular offence described in the policy has in fact been committed. The policy may be extended to cover acts which are not criminal, such as willful default or the negligence of an employee. However, it does not cover losses due to a crime where the employee has not been guilty of any fault, for example, where they are robbed of money belonging to the insured. For the purposes of determining loss, generally speaking, and depending on the wording of the policy, it is assessed as taking place when the employer's property is misappropriated and not when the misappropriation is discovered by the insured. However, the policy may, in express terms, cover losses discovered during its currency. From what we have seen in practice, policies have responded to losses discovered during its tenancy for employee misappropriations that have occurred either prior to or following the policy expiry. As such, it's important for both the insured and insurers to look out for this within the wording of the policy. Interestingly, the duty of giving notice of the loss to insurers does not arise until the employer has satisfied themselves of their employee's dishonesty, and there is no duty to notify mere suspicion. However, if the policy fixes a time from the date of loss for giving notice to insurers, the insured will be unable to recover if the time has expired before they become aware of and subsequently notified the insurer of the loss. While this may be good news for insurers, insured should be aware of their policy wording and not overlook such a clause, as they do so at their own peril. So everyone wants to know about the part played out by prosecution in all of this, and obviously it features. The insurance policy may contain a condition requiring the employer to prosecute the defaulting employee upon the request and at the expense of the insurer. Failure to comply may preclude the insured from enforcing the terms of the policy when required. If, as a result of the successful prosecution, the employer recovers any portion of the misappropriated property, the insurers are entitled to recover their costs through deducting the amount recovered from the amount that they are required to pay the insured under the policy. The amounts owing to the employee by way of remuneration may be deducted from the amount of loss, and the insurers are liable for the balance up to the sum insured. However, where the amount of loss is greater than the amount insured, the insurers remain liable for the balance up to the full amount insured. It is becoming more common for insurers that offer fidelity insurance to ask for dual authorization for any financial transactions over a certain amount. This method is used by many financial institutions already, and insurers may insist that there are two independent signatures on checks or that any electronic transfer of funds is witnessed and documented by another director or employee. It follows in these circumstances that if this second authorization check is not made, any subsequent first-party fraud may not be covered by the policy and insurers may refuse the claim. Insurers will often ask within the proposal form or statement of fact whether the annual accounts of the insured organisation have been audited and if dual authorization is in place. This acts to alert the firm that these procedures should be in place for fidelity insurance to apply. On the flip side, other insurers will simply include these terms within the conditions or exclusions of their policy wording. So, what are the takeaways from today's session? If insurers wish to exclude employee fidelity within general fraud clauses, they should do so expressly, otherwise it will be assumed to be included within the policy. Calculation of loss should be looked at closely, as generally losses are assessed as taking place when the misappropriation took place and not when it's discovered by the insured, unless this is expressly written into the policy. Insurers may consider including mandatory time constraints on notifying losses, and the insured should check this obligation in the wording of its policy. And insurers might check their wording to impose a dual authorization process and administering all transactions dealing with the company's funds, financial deals, and/or banking. Well, I don't have any more to say today, but Harriet, do we have any questions and time to address them?
Yes, we do, notwithstanding the vast amount of information you've passed over. Thank you very much indeed. It's very interesting. We've just got enough time for one or two. Question, when you were speaking about the ambit of fraud, you gave us some examples, 4 examples, I think. I mean, there may be an obvious answer to this, but how can insurers protect against claims being made in the first place if an insured doesn't have sufficient checks and balances in place?
Well, no one can prevent against everything, but if they don't already, I would be advising insurers to check out precisely what risk management procedures are already in place at the insureds and whether the insured can illustrate that those procedures are actually employed regularly. For example, the dual authorization policy that I was talking about before. There is a pressing need for insurers to be mindful of the wording being used in the policies, and if they wish to exclude employee fidelity, as previously mentioned, they must use precise, explicit language.
So basically, with this sort of insurance, there needs to be a real minute understanding of what's wanted and what's required and what's given.
Yeah, I would say so.
Yeah. I mean, you may not want to stick your neck out on the next question or answer to the next question, but in light of the increase in fraud in the current business arena, would you say that fidelity insurance should be viewed as a crucial purchase, particularly to the success of any business involving, for example, sales, investments, banking, or finance?
Yeah, I would say that it would be. It focuses the mind of those working at management level, keeping a keen eye on their administrative processes, and it also provides an idea of what's going on the shop floor, so to speak. And I think ideally a business would have a separate employee fidelity policy, but if not, they should ensure that it at least has cover within another policy, such as the theft clause within a PI policy.
Yeah, I can see that. I mean, we could go on chatting forever, Arabella. There's so much to say about this, but we're going to run out of time if we do. So on this occasion, to keep within our time frame, I'll pass the baton back to you to wrap up, if I may.
Okay, thanks, Harriet. For those in the audience today, we appreciate your views and comments. And if you could please complete the feedback form before leaving, that would be really helpful. Your views are important to us and we want to hear from you. You'll be sent a recording of today's session shortly. And our next session will be on Thursday, the 23rd of May hosted by Alistair Dick and Alana Williams, who will be talking about warranties and indemnity insurance. So please look out for your invitation to that. We hope you'll join us on that occasion. But yeah, thank you very much for attending today. We hope you've enjoyed this session and found it useful, and have a good rest of your day.